Welcome to my channel Fiscal Voyage. I'm Felix. So I've been doing a series covering different companies that are part of the Dividend Aristocrats. The Dividend Aristocrats are companies that's been growing dividends for 25 or more years. So if this is your first time visiting my channel, make sure to hit the subscribe button because tomorrow I'm going to post another video covering the next Dividend Aristocrat. So in this video, we're going to cover Cisco Corporation. This company actually has been growing dividends for 50 consecutive years. And make sure to watch towards the end of the video because later in the video, I'm going to provide you with a fair value price and my recommendation, either is a buy, hold, or sell. And after that recommendation, I'm also going to provide you with the reasoning of that recommendation. So let's get started. Okay, Cisco Corporation, ticker symbol SYY. The company is a multi-international corporation involved in marketing and distributing food products, small wares, kitchen equipment, tabletops, items for restaurant, healthcare, and educational facilities, hospital business like hotels and inns, and wholesale to other companies that provide food services. If we go ahead and look at the fundamentals, revenue from 2010 to 2019 grew at a nice rate at 5.5%. Net income slightly lower at 4.0%, but is a decent rate for this size and long company that's been around for a long time. Triple B minus credit rating. That's still investment grade, but at the very low end of investment grade. Operating income from 2010 to 2019 was 1.9%, and earnings grew at 6.9% for that 10-year period, which is great. However, for the past 5 years, earnings has a 5-year average of 17.8%. So they've been growing earnings for the past 5 years, much better rate than the 10-year average. And net income for the past 5 years, a much better rate as well of 24.9%. So they've been definitely growing the company over the past 5 years versus the 10-year average. So we'll continue with the fundamentals. 2019 earnings came in at $3.55. This company has very low margins. Net margin for last year was 2.8 and 2.4 for 2018. So it's gone as low as 1.4 in 2015. So the net margin or the margin is very, very tight. Return on equity was 66.8%, which is great. The higher, the better. Current yield is a decent, respectable 3.18% yield. And they have a 5-year dividend growth rate of 6.1. This gives us a charter rule of 9.2. So that is lower than what I like to see. I like to see 11 or higher, 10 or higher. Worst case, 10 or higher. But just FYI. But they did increase the dividend by 15% in November of last year because of the higher earnings that they've been growing for the past 5 years. So they increased the dividend by 15%. I don't see that happening again this year. You'll see later on, we'll talk about that, but I don't see a 15% dividend growth this year, maybe around 5% or so. They have a dividend payout ratio of 87%, which is high, but this is based on 2020 expected earnings. So it might be a little higher or less because we still don't know the earnings for 2020, but these are based on expected earnings of 2020. So we come with 87%. So I still see the dividends safe because they've been growing dividends for 50 years. So they do have a high payout based on 2020 earnings, but 2021 is expected to be higher earnings, so therefore dropping the payout ratio. So if we look at the balance sheet now, debt to cap is fairly high at 78%. The current ratio, which is the current asset divided by current liabilities, gives us 1.48. So it's right there where we like to kind of, I guess, the norm, the okay, which is 1.5. So it's right there. Debt to equity is high, however, at 5.2. I like to see debt to equity of 2 or less, 1.5 or less, but this is almost triple of that. Price to book is also high at 14.2 versus the 5-year average of 11.4. So that's something to see there. Normally, you like to see price to book ratio of 3 and less, 4 and less, maybe even 5 and less. but you got here 14.2 base and versus the 5-year average of 11.4. So this right here is a good indicator that it's overvalued. So let's look at future outlooks. Analysts expect 2020 earnings to come in at $2.02, 2021 to be $2.40. Analysts also expect earnings to grow at 5% for the next 3 years, and my dividend yield return model came in at 8% total return, which is the earnings growth plus the dividend yields. So we get about 8% total return. However, currently the company has a PE of 26.6 and the forward PE is of 25. This right here is actually pretty high in my opinion for such a company that is not really a growth company. So 25 PE based on forward earnings and a 5-year average of 27. I mean, that right there looks pretty good, but again, that's a very high PE. If I was to consider a company, I like to see a PE of 18 or less, 16, 15, depending on the industry and the average, but 25 PE at current prices. If we look at the fast graph, again, the black line is the monthly closing price. The orange is the earnings with a 12.6 multiple, and the blue line is the normal PE of 19. As you can see here, 2020 earnings are, like I said, expected to be at $2.02, and 2021 at $2.40. If it goes back to the normal multiple of, let's say, 20, you have a potential of losing money here based on this fast graph of negative 12.1% of total return. So actually not getting money or growing your money. I think the company is great. However, you can see for a few years from 2013 to 2014, it was kind of flat earnings. It had a negative 8% in 2013 in earnings and negative 1%, but then it picked up on 2015 and 2016, and 2018 had tremendous growth, 34%. But again, the black line is over both the blue and orange, so that's an indicator based on the fast graph that is overvalued. Let's actually see what other analysts expect their fair price to be. CFRA has a fair price of 48, Morningstar at $52, Fast Graph at $46.52, Yahoo at $55.14, and my dividend discount model analysis at basically $40. For my dividend discount model analysis, I was kind of a little optimistic with this one because I use a 7% dividend growth for the next 3 years and 5% after that with a discount rate of 10. That's how 39.90 came up. I don't see the company growing dividends at 7% for the next 3 years. It might be less, I think, but I use that because since they grew the dividends at 15% in November, they may increase it at 7%. I don't think that's happening. But if I did it like at 5% for the next 3 years, that number would be much, much lower. So I was trying to be more or less in line with the other ones, but that to me is a fair price based on the dividend discount model analysis. But averaging out the 5, we get a fair price of $48.32. Currently, the company goes for $59.16, which means it's overvalued by 18%. So my current recommendation for Cisco Corporation is a hold. So I gave a hold recommendation for Cisco Corp. One thing I don't like is the very tight margin. Last year was 2.8%, and the previous years were less than that. So that's something worries me. I also don't like the high debt to equity ratio of 5.2. I like to see companies at least 2 or less, 1.5, 1, even less. But at the very highest 2 as my criteria, but this has a 5.2 debt to equity ratio, which is very high. And another thing I don't like is the price to book of 14.2. That's high as well. I like to see price to book value around 5 and less, 4, 3, to make it attractive for me, in my opinion. But this has a price to book of 14, and the 5-year average for price to book has been 11, so it's higher than the 5-year average. And another thing I don't like is the high PE ratio of 25. So that's, to me, is very high for such a well-established company with not too much growth. But I do like the dividend history of 50 years, consecutive growth. The last year they increased it by 15%. This is a company that's very, very stable. I see it actually a lot of times when I'm driving. I'll see their Cisco trucks. It's always a company I've actually been wanting to own shares of, but it's always been, in my opinion, high. So I've purchased other shares that of other companies that have been undervalued. So I've always been held off with this one. I've always liked it, the business model and such, but I always found it a high valuation. I would find this company more attractive in the low 40s, maybe high 30s, $37, $38 a share, or maybe even $40, $41 a share. Then I'll find it more attractive for a purchase, but not at today's prices. So thanks for watching. Again, if this is your first time visiting the channel, make sure to hit the subscribe button for tomorrow's next Dividend Aristocrat. So I'll see you guys tomorrow and have a good one.